Chapter 12 CRVI. So guys, don't miss chapter 12 and 13 theory, because for from chapter 12 one question and chapter 13 one question. So out of 20 questions of valuation, 10 questions they are asking from theory itself. So if you are lacking any confidence in the valuation, then you can prefer theory. So do well. Valuation process has four parts. First, pre-valuation, next investigation, next data handling, next post-valuation. So pre-investigate, data and post. Pre-investigate, data handler and post. So in pre, where the valuer and the client agree on the terms of the engagement. Even in a peer review also happen the same thing in pre-bid meeting, like that. And second, investigation, which is a formal or systematic examination or research undertaken on the property. Third, data handling and interpretation, which requires processing and calculation of data, qualification and verification of data, and analysis of data. Fourth, post valuation process reporting, which provides for single value presented in the valuation report. Next, genesis of valuation. In this they gave meaning of valuation. So valuation is a process of determining economic worth of an asset or a company under certain assumptions and limiting conditions, and subject to data available on valuation date. So this valuation is subject to data available on valuation date only. Need for valuation. Valuation of a business plays a vital role. Therefore, a business owner or individual may need to know value of a business. The fair market value standard consists of an independent buyer and seller having the requisite knowledge and fact, not under any undue influence or stressors, and having access to all of the information to make informed decisions. So now the below above para 3 lines they gave, no? From that 3 lines only question may be formed. So read cautiously. Business valuation is carried out to know the business and helps in strategic management decision making. Comment. Answer is this need. And appropriate purpose of valuation becomes the basis of valuation. So appropriate purpose, that is also need only. The strategic decision making in business valuation may related to following. This also they can ask. So 4 possibilities are there. These 3 headings are directly need for valuation. So how to remember this? First, point 1, 2 and 4. These 3 is related to restructuring. So first, merger, acquisition or takeover, and strategic plan, partnership, joint venture, collaboration at the time of peaceful exit. Okay, these 3, 1, 2, 4 is restructuring, and 6, 7, 9 is related to law. 6, 7, 9. 6 is company law, 7 is other law, 9 is court directed valuation. So NCLT related and all. Next, 3 and 12 related to shares and debentures. So we have covered 8 points, more than enough. So first, 1 to 4. So merger, acquisition, takeover, strategic partnership, joint venture, collaboration, and at the time of peaceful exit. First 2 points you can explain. Third, exit point, valuation is required to be worked out at the time of resolving the disputes among stakeholders. Purchase of equity from dissenting from dissenting shareholders, the acquirer will purchase the shares and give the payment. That should be peaceful. For that also valuation is required. So 3 points. And law, company law related aspects of valuation and other law, where and all valuation is required under FEMA, SEBI, Stamp Act, Customs, Income Tax Act, and court directed valuation. Sometimes the business valuations are carried out as per the directions of the court. NCLT issues directives and appoint valuers. NCLT appoints the valuers in the matter of operation and mismanagement. High Court appoints valuers to resolve disputes and winding up the matters. Okay, next, 6, 7, 9, that also done, and left with 3 and 12. That is shares and debt. 3, ESOP, ESPS and employee retention. About ESOP and about ESPS and employee retention bit in 3 paras if we write also, more than enough. And 12th, at time of debt funding, while company want to raise any fund through debt, that also valuation requires. Next, factors influencing the valuation. After having done the due diligence process, the next step is to value the business for the purpose of deciding the swap ratio. So why we require valuation is to decide the swap ratio. A company will change the hand of ownership only when the fair market values are valid to the satisfaction of the owners or sellers company. And similarly, the buyer company will be ready to pay the price if it is beneficial interest of its owners too. So even if buyers also should satisfy, seller also should satisfy, and it should be the fair market value, and also to decide the swap ratio between the seller and buyer. The valuation of assets and liabilities of a business entity depends upon various factors. These factors may be. So first one is third point, the price of the shares trading at board's means company document of the companies before the news of the merger deal and after the announcement of the deal. So before the deal, what was the price? After the deal, what was the price? So majorly we are into merger amalgamation, these all. So because of this we have to do the valuation. So because of first considering before date and after date of announcement. And next continually net worth is that point. Net worth of the company, net assets of what the business will be valued on. So net worth, net assets, liquidity. Net worth, net assets, liquidity. And underlying net tangible asset, underlying net tangible asset, underlying net tangible asset. And conditions of the business, whether running or closed. If running, more value, closed means no value, like that. Conditions of business. And future earnings and projections. So for buyer, what will be the his expectation is future earnings and projections. And last three, cash flow, NPV, ERR, cash flow, NPV, ERR, cash flow, NPV, ERR. And coming to the first, for past dividend track record. So in past, what is the dividend track record? Present we can know, past we don't know. No, sir. Past dividend track record of the company. Past earning, past dividend, past earning, past dividend. So on the basis of dividend and earning, how much bonus they have? So that also bonus track record, bonus track record, bonus track record. And out of the money they have, how much they have raised from the IPO or FPO, IPO or FPO, IPO or FPO. And voting strength in the merged entity of the shareholders. Voting strength in the merged entity of the shareholders. How much voting strength our company will have when we get merged into another company. Next, general principles of business valuation. First, time and risk and return, time, risk and return, substitution, alternative, expectation, reasonableness. In any transaction, there will be the extra expectation, so that you can easily remember. And in any business, there may be one or the other alternative. So substitute and alternate will be there. Substitute, alternate, and alternate. And business depends on how much risk you take, so that the return will come. Risk and return, and time value of money will increase, decrease, and all. Time value of money. And last, reasonableness. In valuation, the principle of reasonableness is important. It takes into consideration various aspects: nature, historical background, brand image, book value of the stock, earning capacity, dividend track record, etc. If according to all these principles we are satisfied, then we can go ahead with the merger transaction. Purpose of valuation. World valuation has been debated in India. That not required. Go to second para. Section 247 of 2 mandates that valuer, that is registered valuer, shall make an impartial, true and fair valuation of any assets. Second, exercise the due diligence while performing the functions as a valuer. Third, make the valuation in accordance with the valuation rules. Fourth, not undertake valuation of any asset in which he has a direct or indirect interest, or he becomes so interested at any time during 3 years prior to his appointment as a valuer, or 3 years after the valuation assets conducted by him. So 3 years before, 3 years after. This is the only provision where we have read not only before, even after will be considered. So 3 things, actually 4 things. 4. First, impartial and true and fair, and due diligently should do, and violation should not do, and should not take under the valuation if he is interested, direct or indirect. That will be checked 3 years past, 3 years future. And in present also, if he is interested, he will not be eligible. So in either of the way, 3 years past, 3 years present, 3 years future and present, all he should not be interested. Next, Companies registered values rules provide for first registration of the values. Normally we'll read as registered values. So where he'll get registered? In the registered values rules. Who may be individual or a partnership firm or a company. So registered valuer can be three: individual, partnership firm, company. Individual, partnership firm, company, with IBBI for conduct of valuation of different classes of assets under Companies Act, and who has a recognition of a registered valuers of organization to enroll valuer members. So the name who under whose registered valuers organization mentioned, no, only they can act as a registered valuer. Enforce a code of conduct on them and conduct the training and educational courses for its members. C. Mechanism for notification. Mechanism for notification and modification of the valuation standards based on the recommendation of the committee or committee to advise on valuation matters. So based on the committee's advices, change or modification in the valuation standards will be happening. Next, only a person registered with the authority as registered valuer can conduct valuations required under the code. Subject to meeting other requirements, an individual is eligible to be registered valuer if he is a fit and proper. Means normally above rules has to qualify, but first this, after this only he can go for the above rules. First, he should be fit and proper person, has the necessary qualification and experience, is a valuer member of an RVO. So only RVO member can be a registered valuer. Has completed a recognized educational course as a member of an RVO. Has passed the valuation examination conducted by the authority within 3 years preceding the date of making the application for registration, is recommended by the RVO for registration as a valuer. So the person should be recommended by the RVO for registration as a valuer. The individual is required to have either postgraduate qualification in specified discipline and 3 years experience, or bachelor's degree in the specified discipline and 5 years experience. Next, valuation standard. These standards have been came into effect to avoid the financial collapse. The concern to avoid such collapses led to emergence of valuation standards, first on a national, then on international, and two sets of standards: International Valuation Standard (IVS) and Royal Institution. First one, IVS, is issued by the International Valuation Standard Council. So IVS is issued by IVSC. So we should add the word council. That's all. The Royal Institution of Chartered Surveyors, RICS. Red Book, command great respect among the stakeholders. IVS comprises of 5 general standards and 6 asset specific standards. General standards contain: first, standards applicable to valuation of all asset classes, covering scope of work, investigation and compliance, basis of value, valuation approaches and methods, and reporting. Standards includes requirements related to specific type of assets valuation, that is including background information on the characteristics of each asset type. Background information, why? See, there are 2 assets. One asset gone through the standard depreciation on standalone, and one more on the basis of written down value. So the valuation differs now in each method. So history of the asset is required. Background information on the characteristics of each asset type that influence value, C, and additional asset specific requirements regarding common valuation approaches and methods used. These covered businesses and business interest, intangible assets, plant and equipments, real property interest, development property, financial instruments. IVS allow flexibility to meet national requirements. Reportedly, some countries have adopted IVS as national standards and some have adopted IVS with amendments to meet the requirements of the national legislations. So some of them as it is adopted, some of them made changes and adopted. RACS Red Book adopts and applies IBS. The standard take three forms. First, professional standards centered around ethics and conduct. Next, first professional. Next, technical standards centered on common definitions and conversation. And third, performance. So first one is professional technical performance. Professional technical performance or delivery standards centered on rigorous in analysis and objectivity of the judgment. And four specific guidance notes, that is valuation for financial statements, valuation for secured lending, development land in India, valuation for tax purposes. Regulatory aspects as to valuation. Valuation provision under Companies Act 2013 to Section 247. Section 247 seeks to provide that valuation in respect of any property, stock, shares, debentures, securities, goodwill, or any other assets or net worth of a company or its assets or liabilities shall be valued by a person having such qualification and experience and registered as a valuer in accordance with such rules. So everything, assets, liabilities, goodwill, debentures, securities, everything will be valued by the valuer. This is according to Section 247. Valuation by the registered valuer. And first point is repeated of the earlier and from fourth line. And being a member of an organization recognized in such manner and such terms as conditions may be prescribed and appointed by the audit committee. This is only new thing. Audit committee, appointed by the audit committee, or in its absence by board of directors. Normally appointed by audit committee. If they are not there, board of directors. The valuer appointed under shall make an impartial, same points repeated as we read earlier. If a valuer contravenes the provisions and rules made therein, he shall be punishable with the fine not less than 25,000. 25,000. So valuer will be punishable with not less than 25, means minimum 25,000 will be, which may extend to 1 lakh. So 25,000 to 1 lakh punishable. Provided that if the valuer has contravened such provisions with the intention to defraud, he shall be punishable. Normally, if he did any contravention, only 25k to 1 lakh enough. But with the defraud intention he did, then punishable with imprisonment for a term which may extend to 1 year, and fine. 1 year and fine shall not be less than means starting only 1 lakh. 1 lakh is the minimum. 1 lakh, but which may extend to 1 lakh to 5 lakh, 1 lakh to 5 lakh, 1 lakh to 5 lakh. So two categories are there. Normal contravention 25 to 1 lakh, but if with the intention of defraud, imprisonment minimum 1 year and fine which may extend to 1 year. So there is no minimum limit. Maximum limit is 1 year and fine is minimum 1 lakh to 5 lakh. Where a valuer has been convicted, he shall be liable to refund the remuneration received. Remuneration he has to receive and pay for the damages. Remuneration also should receive and pay the damages to the company or to any other person for loss arising. So refund and damages or to any other person, damages to the company or to any person for loss arising out of the incorrect or misleading statements. Done. And company's rules in that second para means equality or comparability should be, all should follow same set of guidelines in making the evaluation report, that they are saying. Though there are some consensus among the professional valuers about generally accepted approaches, methods and procedures, however a need was felt for education, training, regulation and standardization. So standardization is the main aim of prevalent practices in valuation. Next is rule 3, eligibility of registered valuer. Provides that a person means here 3 people are there: normal individual, partnership firm and a company. 3 shall be eligible to be registered valuer if he is a valuer member of the RVO. And a registered a valuer, still he not registered, no? So normal, a valuer is a member of a registered RVO who possesses the requisite educational qualifications and experience for being registered as a valuer as given by the RVO. Is recommended by the RVO, of which he is a valuer member of RVO for registration as a, means RVO should recommend the appointment as a registered valuer. C has passed the valuation examination under Rule 5 within 3 years preceding the date of making an application for registration. Means once he makes the application for registration, in that 3 years he has to pass the valuation examination. Only then he can be registered valuer. possess the qualification and experience. He is not a minor, not declared as an unsound mind. He is not an undischarged bankrupt or applied to the adjudicators as a bankrupt, and is PROI. And I point is like convicted by a competent court involving moral turpitude for and sentence imprisonment for a term exceeding 6 months, and if period of 5 years has not lapsed, means if period of 5 years lapsed he can be, if not lapsed he cannot be, and if 7 years or more imprisonment has been sentenced, then he shall not be eligible to be registered at all, and has not levied a penalty under section 271J of Income Tax Act. And the timeline for filing appeal before Commissioner of Income Tax Appeal or Income Tax Appellate Tribunal, as the case may be, has expired. So he should not be levied a penalty under the 271J of the income tax. Even if he got levied, the time for preparing the appeal should be lapsed, because if there is a time, there is a chance that he is not eligible to be disqualified to be appointed as registered valuer. So until the time for appeal elapses, he will be counted, or such penalty confirmed by the income tax appellate, and 5 years have not lapsed. So if 5 years has been lapsed, okay, in two situations: first 6 months moral turpitude, then 5 years lapsed means okay, and in this also under income tax, if 5 years lapsed from penalty, that also okay, he can be eligible to get registration. Is a fit and proper person. The authority may take account of any relevant consideration, including but not limited to integrity, reputation, character, absence of convictions, competencies, and financial solvency. No partnership entity or company shall be eligible to be registered valued. If until now we have read about individual, now about partnership entity or company. So it has been set up for the object other than for rendering professional or financial services, including valuation services, and that in the case of company, it is a subsidiary, joint venture, associate of another company or body corporate. So in company, it should not be subsidiary of it should not be a subsidiary, and in partnership, other than partnership forms, they have started, it is undergoing an insolvency. They themselves are into an insolvency, so they cannot value the others. All the partners or director, as the case may be, are not eligible. So partners, if not eligible, no, they cannot value, they cannot apply for the registration of as a valuer. 3 or all the partners, directors, whichever is lower of the partnership entity, as the case may be, are not the registered value. So majority of the director or partner should be registered value, so that entire firm will be of registered valuer firm or registered valuer company. None of the partner or director is a registered valuer for the asset class for the valuation of which it seeks to a registered valuer. Next, rule 4, qualification and experience. First, post-graduation degree or post-graduation diploma in the specified discipline from the university or institute. A bachelor's degree or equivalent in the specified discipline from a university or institute established and recognized and incorporated by law in India. At least in first one, there is a at least 3 years of experience. Here at least 5 years of experience. For post graduation, 3 years experience. For a bachelor's degree, 5 years experience. And membership of a professional institute established by an act of parliament enacted for the purpose of regulation of profession with at least 3 years. So membership of professional means 3 years, bachelor 5 years, post graduation 3 years. Valuation examination and certificate of registration. Rule 5 and 6. An individual who passed the valuation examination shall receive the acknowledgement of passing the examination, means result card, marks card. After submitting necessary papers along with the application for examination, the authority upon satisfaction may grant the certificate of registration to the applicant to carry out activities as a registered valuer. Rule 7. The registration granted under Rule 6 shall be subject to condition that valuers shall be eligible at all times and qualified and experience criteria should be fulfilled, and at all the times comply with the provisions of the Act, rules, bylaws, and in his capacity as a registered valuer, not conduct valuation of asset if it has registered by the authority. In his capacity as a registered valuer, not conduct valuation of asset or class of asset other than means for which he has been registered, only that category of assets he has to do the registration. Take prior permission of the authority for shifting membership from one registered valuer organization to another. So there are many registered valuer organization. If he want to shift from one to one, he has to take the prior permission of authority. Take adequate steps for redressal of grievance. Maintain records of each assignment undertaken for at least 3 years. Comply with code of conduct. In case of a partnership entity, why 3 years? Did you got the logic? In earlier we have read like he should not get into the assignment which if he is interested for last 3 years, and future 3 years will check. So for that means he should show the proof that in past 3 years I have dealt with this, so I am not interested, and I can take up the valuation. To prove that, he has to maintain records. Comply with the code of conduct of the registered value organization of which he is a member. In case of a partnership entity or company, its registered valuer allow only the partner or a director who is registered valuer for the asset class that is being valued to sign and act on behalf. So there will be different class of assets, right? Partner A, partner B, partner C, D. Different class for each of them registered for different class. For which class he is registered, only that class he has to evaluate. That what they need. In case of a partnership entity or company is a registered valuer, it shall disclose to the company concerned the extent of the capital employed or contributed in partnership entity or company by the partner or director, as the case may be, who would sign and act in respect of valuation report. In case partnership entity is a registered valuer, be liable jointly and severally along with the partner who signs and acts in respect of the valuation assignment on. So normal condition only partnership. In partnership for acts of one partner, all rest of the partner will be liable. Here also same thing. In case of a company is a registered valuer, be liable along with the director who signs and in respect of valuation report on behalf of the. So all will be liable. All directors, I mean. In case of a partnership entity or company is registered valuer, immediately inform the authority on the removal of a partner or director, as the case may be, who is registered valuer along with the detailed reason. So if any partner or director is getting removed, reason should be given, provided if the person who is getting removed is a registered valuer only. Comply with such other condition as may be imposed by authority. Conduct of valuation. Rule 8. The RV shall conduct a valuation complying with the valuation standards as notified or modified under Rule 18. Until the valuation standards are notified by or modified by the CG, a valuer shall make valuation as per internationally accepted valuation standards, valuation standard adopted by RVO. The RV may obtain input from his valuation for his valuation report, or get a separate valuation for an asset class conducted from another RV, in which case he shall fully disclose the details of the inputs. Means he have seek the opinion from other RV while conducting the valuation, that he has to disclose. The valuer shall in his report state background info of the asset being valued and purpose of valuation and appointing authority who appointed him, like that. Identify of the valuer and any other experts involved in the valuation, disclosure of valuer interest, date of appointment, valuation date and date of report, inspection or investigation undertaken, nature and sources of the information used, procedure adopted in carrying out valuation and valuation standards followed, restrictions on use of the report. Means they will give according to my language or according to the present law or as on the date, that is a restriction. Major factors that were taken into account during the valuation. Conclusion. Caveat and limitations and disclaimer to the extent they explain or elucidate the limitations faced. So if a company or the person or company who is being valued by the valuer, if they impose any limitations, what and all the limitations were, that also it should form part of the report. which shall not be for the purpose of limiting his responsibility of the valuation report functions. The valuer shall conduct valuation required under Act as per the rule. These rules. Eligibility for RVO. An organization that meets requirements under sub-rule 2 may be recognized as the registered valuer organization for valuation of a specified asset or specified asset class or classes. It has been registered under Section 25 of Companies Act 1956 or Section 8, that is, it is a NPO, with the sole objective of dealing with matters relating to registration of valuers of an asset class, or only purpose of the of this RVO should be to deal the matters relating to regulation of the valuers. And it is a professional institute established by the Act of a Parliament enacted for the purpose of regulation of professional, provided that the following organization may also be recognized as a registered valuer organization for valuation of a specific asset class or classes. First, an organization registered as a society. So first one was NPO, and now it is a society under Society Registration Act or any other state law. So Society Registration Act is for all and relevant state also will be having separate society act. That an organization set up as a trust governed by the Indian Trust Act. So trust, NPO and society. Trust, NPO, society. For trust there is specific condition also. For the society and trust no specific condition. The organization referred shall be recognized if it conducts the educational courses. When the organization will get recognition as a registered valuer organization, means it should conduct the educational course in valuation with the syllabus determined by the authority under Rule 5. For individual who may be valuers members delivered in classroom or through distant education module which include practical training. So education and practical training should give, and syllabus determined by the authority, only that they should teach. Grant the membership or certificate of practice. Grant the so think of ICSI, how ICSI will do, like that only these also should be eligible, only then it will be RVO. So grant membership or certificate of practice to individual who possess the qualification and experience as specified in Rule 4 in respect of valuation of asset class for which it is recognized as a RVO. Conduct training for individual members before COP is issued to them. So training should conduct before issuing the COP. Lay down and enforce a code of conduct for valuers. So code of conduct. Even before we getting the COP, we have to undergo the 21 months training, and we have to follow the code of conduct all the time. Lay down the enforcement code of conduct. Provides for continuing education of individual who are its member. Monitor and review the functioning, including quality of services, valuers who are its members, and mechanism to address the grievance, and conduct disciplinary proceedings against the valuers who are its members. RVO being an entity under shall convert it into or register itself as a company under Section 8 within 1 year. Means entity means, that is, I think it if it is registered under Section 25 of old itself should convert to new Act 2013 Act within 1 year from the date of commencement of these rules. Model code of conduct for registered values. First, integrity fairness. For CS also will be same, na? So instead of CS we can put the word valuer and write the same thing. So integrity and fairness, professional competence and due care, and independence and disclosure of interest. Confidentiality means whatever he have conducted the valuation, that should be confidentiality maintained. And information management, gift and hospitality. He should not accept any gift from the company which he is doing the valuation, because his independence will be get affecting. Remuneration and cost, occupation, employability and restriction. The SEBI ICDR regulations 2018. Face value of equity shares. The disclosure about face value of equity shares shall be made in draft letter of offer. Draft offer document, advertisement and application form along with the price band or issue price in identical font size. Regulation 28 pricing. The issuer may determine the price of equity shares, and in case of convertible securities, the coupon rate. Normal for equity shares price, for equity shares price, and for convertible securities coupon rate, and the conversion price, both for a convertible to coupon rate and conversion price, in consultation with the lead manager or through book building process, as the case may be. The issuer shall undertake the book building process as manner specified. Price and price band. The issuer may mention price or price band in the offer document. In case of fixed price, and a floor price or a price band in case of red herring. So from first, in case of a fixed price, he will mention price or price band in the offer document. In case of book building, floor price or price band in the red herring, and determine the price at the later date. Before filing the prospectus. So before filing the prospectus with ROC, should determine the rate, provided that prospectus filed with ROC shall contain only one price or the specific coupon rate, as the case may be. The cap that is highest price, the cap on the price band and the coupon rate in case of convertible debt shall be less than or equal to 120% of the floor price. Means gap between two prices should be minimum 20%, provided that the cap of the price band shall be at least 105% of the floor price. Next, the floor price or final price, floor or final price shall not be less than the face value of the specified securities. Where the issuer opts not to make the disclosure of the floor price or price band in the red herring prospectus, the issuer shall announce the floor price or price band at least two working days before the opening of the issue in the same newspaper where pre-issue advertisement was released, or together with the pre-issue advertisement. So at least 2 working days or together with the pre-issue advertisement, either in the ways he can announce the price if he not disclosed in the red herring prospectus. Announcement referred to shall contain. So what announcement will be containing? Relevant financial ratios compared for both upper and lower end of the price band. Means to come to the upper band price, that is cap price, what formula used, and for lower price what they have, on the what basis they have decided. And also statement drawing attention of the investors for the section titled basis of issue price of the offer doc. Announcement referred in subregulation 4 and the relevant financial ratio referred shall be disclosed in the website of what stock exchange, and shall also be pre-filled in the application forms to be made available to the websites of the stock exchanges. Differential pricing means for different persons different pricing allowed. Yes, allowed. The issuer may offer its specified securities at different prices subject to RII for retail investors entitled for reservation made under. So RII reservation can be made out of the shares getting issued. May be offered specified security at a price lower, but not lower than the 10% of the price at which net offer is made to other category of the applicants, excluding the anchor investment. Means for anchor investor what we are charging, that will be not included for the calculation of 10%. For HNI, for other small shareholders and all, how much for them company is charging for them, and for RII maximum gap should be 10% only, not more than that. And in case of a book built issue, the price of the specified security offered to anchor investors shall not be lower than the price offered to other applicants. So for anchor investor, minimum all the time for them we should charge higher price. So they kept the lower limit. Higher how much the company wish to can charge shall not be lower than the price offered to other applicants, that is HNI and RRI. In case the issuer opts, it means for HNI and RRI we can charge less compared to anchor. In case the issuer opts for alternate method of book building, that is alternate book building, the issuer may offer the specified securities to its employees at a price not lower than more than 10% of the floor price. So compared to floor price, 10% can be reduced, but that is a maximum limit for employees through alternate book building method. Pricing of frequently traded shares. If the equity shares of the issuer have been listed on recognized stock exchange for a period of 90 trading days, for 90 trading days or more as on the relevant date, the price of the equity shares allotted pursuant to shall not be less than the higher of the following, that is A and B, whichever is higher. First, 90 trading days volume weighted average price, that is VWAP, of the related equity shares quoted on the recognized stock exchange preceding the relevant date. The 10 trading days volume weighted average price of the related equity shares quoted on a recognized stock exchange preceding the 10 days preceding the relevant date. First, we'll calculate the average price of the 10 days. For that, we'll assign the volume, how much has been placed order. So, volume weighted average price. So, for average price, we are weighting how much weightage they have been purchased. That is a volume weighted average price. So, depending on 90 trading days and 10 trading days, provided that if AOA of the issuer provide for a method of determination which results in a floor price higher than the determined under this regulation, then the same shall be considered as a floor price for the equity shares to be allotted for preferential issue. Means now according to A and B we got the 100, and according to the AOA they are saying 105. So 105. If the equity shares of the issuer have been listed on a recognized stock exchange for a period of less than 90 trading days as on the relevant date, the price of the equity shares to be allotted pursuant to preferential issue shall not be less than the higher of the following. Here also same, but 3 conditions are there. Among these 3, whichever is higher. First, the price at which equity shares were issued by the issuer in IPO, or the value per share arrived at in a scheme or compromise arrangement pursuant to which equity shares of the issuer were listed. Okay. Now, means because of the price he got listed in the equity share, that is a price. Either he may be got listed by the IPO or because of the scheme he got listed. Either of the way, the price at which he got the listed. The average of volume weighted average price of a related equity shares quoted on recognized stock exchange during the period of equity shares have been listed preceding the relevant date. Here how many less than 90 is and how much during not known. So how many are there? That many during days. The average of 10 trading days. So for next average of 10 trading days volume weighted average price of the related equity shares quoted on a recognized stock exchange during the 2 weeks preceding the relevant date. So 2 weeks preceding the relevant dates, average of 10 trading days. These 3 amount whichever is higher, provided if AOA provides for more, that only will be floor price. Next, where the price of the equity shares is determined in terms of sub-regulation 2, that is for trading for less than 90 days. Such price shall be recomputed by the issuer on completion of the 90 trading days. Yes, because before it was less than 90, so we computed according to it, and we now 90 days is completed, so again recalculation should do, recomputation. From the date listing on the recognized stock exchange with reference to 90 trading days, volume weighted average price of the related equity shares quoted on a recognized stock exchange during these 90 trading days, and if such recomputed price is higher than the price paid on allotment, the difference shall be paid by the allottees to the issuer. Provided if AOA provide for method of determination results in higher floor price than the determined in the same shall be applicable, and they can take that amount. Next, fourth, a preferential issue at two specified securities to QIB not exceeding 5 in number, means for there are 5 qualified institutional buyers, not exceeding 5 in number, shall be made at a price not less than 10 trading days volume weighted average price of the related equity quoted on a recognized stock exchange preceding the relevant date, provided if AOA prescribes for higher, then higher only. No allotment shall be made either directly or indirectly to QIB, who is a promoter. So promoter means related, so for them no. Promoter or any other person related, provided that if QIB, who does not hold any shares in the issuer and who has acquired the rights in the capacity of a lender, shall not be deemed to the person related to the promoter. Means promoter not shall not be deemed to a person related to promoters. So the person gave the loan, for that person will not be treated as related, and for them can give the shares. For the purpose of this clause, qualified institutional buyer who has any of the following rights shall be deemed to be a person related to promoters. So who is related to promoters? First, rights under a shareholder agreement or voting agreement entered with the promoter or promoter group, has veto rights and right to appoint any nominee director on the board. First one right, second right, third right. If they have any right with respect to the management of the company, then they are related to the promoter. So they cannot take the shares, because there are chances that they may take price at the less price, and from public they are charging higher price. Who knows? So at first only they will be avoided. For the purpose of this chapter, frequently traded shares means shares of the issuer in which the traded turnover on any recognized stock exchange during 240 days. 240 days. See, 2 plus 4, how much? 6. And F letter is also 6. So 60. 6, 246. F is equal to 6 and 2 plus 4 is equals to 6. So 240 days. If shares are getting traded on the stock exchange, then it is a frequently trading days. Preceding the relevant date is at least 10% of total number of shares of such class of the shares of the issuer, provided that where the share capital of a particular class of shares of the issuer is not identical throughout such period, the weighted average total shares of such class shall represent the total number of shares. Next, SEBI, SBEB and sweat equity regulation. Pricing. The company granting options to its employee pursuant to ESOS shall be free to determine the exercise price, subject to confirming the accounting policy specified in Regulation 15. Accounting policies, Regulation 15. So any company implementing any of the share-based schemes shall follow the requirements including the disclosure. So first, SEBI is focused on disclosure. So write off disclosure 1 point. Disclosure requirements of the accounting standards prescribed by the CG in terms of Section 133 of Companies Act, including guidance note on accounting for employee share-based payments. Next, ESPS, pricing and lock-in. Regulation 22. A company may determine the price of the shares to be issued to ESPS under ESPS subject to confirming the accounting policies. So again, accounting policies, according to accounting policies only should give. And second, share issued under ESPS shall be locked in for a minimum period of 1 year from the date of allotment. 1 year. So minimum is 1 year. If company wish to 2 years, okay. Provided that in case where the shares allotted by a company under ESPS in lieu of the shares acquired by the employee under ESPS in another company which has merged or amalgamated with the first mentioned company, the lock-in already undergone in respect of shares be adjusted. So already in A and B got merged. So C is a resulting company, like that. If already holding in A for 5 months, that 5 months will be from 6th month they will start again, not from 0. That what they are meaning. And if ESPS is a part of a public issue and shares are issued to employees at the same price as in the public issue, the shares issued to employee pursuant to it shall not be subject to any lock-in, because even employees also no special treatment, so no special lock-in, normal only should be. Issue of sweat equity by a listed company. The price of sweat equity shares shall be determined in accordance with pricing requirements stipulated for preferential issue to a person other than QIB. So for QIB, pricing will be different. Regulation 20, discovered price. After fixation of the floor price, the discovered price shall be determined through the reverse book building process, because the company wishes to pay less amount in Schedule 2 of these regulations, and the manager to the offer shall The discovered price shall be determined through reverse book building process in the manner specified Schedule 2 of these regulations, and the manager to the offer shall disclose the same in the detailed public announcement and letter of offer. So he'll disclose in DPS and LLO, and through that discovered price shall be determined through RBB process. The floor price shall be determined in terms of Regulation 8. Regulation 8 of takeover regulations as may be applicable. The reference date for computing the floor price would be the date on which recognized stock exchanges was required to be notified of the board meeting in which the delisting proposal was considered and approved. The acquirer shall have the option to provide indicative price in respect of delisting offer, which shall be higher than the floor price calculated in terms of 2. The acquirer shall have the option to revise the indicative price upwards before the start of the bidding period, and the same shall be duly disclosed to the shareholders. The acquirer, if it deems fit, pay a higher price than the discovered price determined in terms of sub-regulation. Next, Company Share Capital and Debentures Rules 2014. First issue of sweat equity Rule 8. Under the Companies Act, the sub-rules Rule 8, the sweat equity shares to be issued under shall be valued at a price determined by a registered valuer as a fair price, giving justification for such valuation. The valuation of IPR, know-how valuation. Because of these three only now we'll issue sweat equity. That valuation has to be done by the registered value for which sweat equity are to be issued shall be carried out by the RV, who shall provide a proper report addressed to the board with justification for such valuation. So both are justification only. First one was for fair price and second one is for technical know and all that three things. A copy of gist along with critical elements of valuation reports obtained shall be sent to the shareholders and with the notice of GM, general meeting. Where sweat equity shares are issued for a non-cash consideration on the basis of valuation report in respect of obtained from the registered valuer, non-cash consideration shall be treated in the following manner. Where the non-cash consideration taken form part of a depreciable or amortizable asset, it shall be carried to the balance sheet, because think depreciation where it will come on asset and amortization on goodwill. So both will go on assets, that is balance sheet. And when it comes to, if A is not applicable, it shall be expensed in the as provided in accounting statement. It will be expensed to P&L account, because that much value not there to carry to the balance sheet, so they will just show as expense in P&L account. Next, SEBI SAST regulations. Offered price is the price at which acquirer announces to acquire shares from the public shareholders under open offer. The offered price shall not be less than the price as calculated under Regulation 8 of SEBI SAST for frequently or for infrequently according to the registered valuer. Consolidated FDI policy. Price of shares issued to the person resident outside India under the FDI policy shall not be less than, so higher of the ABC, the price worked out in accordance with the SEBI guidelines. Listed company are listed on recognized stock exchange, so the price according to SEBI guidelines. The fair valuation of the shares done by SEBI registered merchant banker or CA as per any internationally accepted pricing methodology on arm's length basis, where the shares of company are not listed on NE or SE in India, and the price as applicable to transfer of shares from resident to non-resident as per pricing guidelines laid down by the RBI from time to time, because it is resident and non-resident to India and outside India. So RBI comes into picture. Where the issue of shares is in preferential allotment. However, non-resident, that is including NRI, are making investment in an Indian company in compliance with the provisions as applicable by way of subscription to the memorandum of association. Such investment may be at a face value subject to their eligibility to invest under FDI. Why they gave eligibility means we cannot accept the funds from Pakistan, like that. Valuation requirements under different statutes in India. There are various laws in India which requires valuation from professionals. Example, Companies Act, IBC, Indian Accounting Standards, SEBI, Income Tax, FEMA. So this just under once go through means role of registered valuer in table. And next table is about valuation requirement under IBC. So first one is appointment. This will read in one of the chapter of IBC itself. First one is appointment, and second one is registered valuer, appointment of registered valuers, valuation of assets intended to be sold, voluntary liquidation of corporate persons, the solvency declaration along with the report of valuation of assets of corporate persons, valuation of assets. Next, various expressions of the value. Fair market value, estimated amount for which an asset or liability should exchange between willing buyer and willing seller in an arm length transaction after proper marketing. The parties acted knowledgeably, prudently, and without compulsion. The concept of market value presumes a price negotiated in an open and competitive market where the participants are acting freely. Next, fair value. Fair value is defined as exit price, market based, orderly transaction price. 4 points are there for fair value. First, exit price, the price that would be received to sell an asset. Market based, fair value is determined by the transaction between market participants, that is, one is seller, one is buyer, and is not entity based. It is based on market participants. Orderly transaction, a transaction that assumes exposure to the market for a period before the measurement date to allow marketing activities that are usual and customary for transactions involving such assets or liabilities. It is not a forced transaction, a forced liquidation or distress sale, example. So this is not a forced transaction. Orderly, normal in the course of business, they are into transaction. Price, the price in the principal market used to measure the fair value of asset or liability. Book value is the historical value. Historical, book is a old, so historical. Synonyms to shareholders equity, net worth, and net book value. Net book value, net book value. It is difference between the total asset and total liability appearing in the balance sheet of a company on a particular date. In any balance sheet, assets are recorded at a historical cost, while the net of accumulated depreciation and liabilities are recorded at face value. Net of accumulated depreciation liabilities are recorded at face value. Intrinsic value. Intrinsic means inherent. So inherently how much worth you are. So it is a real value. Intrinsic is a real value of a company based on the fundamental analysis of a qualitative and quantitative factor and does not consider the market value. Market, what is it? I will not at all consider what is my inherent realistic value, that is intrinsic value. It is measured as per the present value of future cash flows from an asset or company by using the appropriate discount rate. So present, what is my inherent value, that is intrinsic. It will not consider the market value. Present with the value of future cash flows, they will convert to the present, and presently what is my inherent value, that is intrinsic value. Replacement value is the current cost of the acquiring a similar new property. So whenever you think of replacing, you will analyze what at that time at what price I have purchased and present what rate. So comparison will come into picture. So replacement value is the current cost of acquiring similar new property which is likely to produce the nearest equivalent utility to the property being valued. An estimate of a replacement cost takes into account on how asset would be replaced with the newer materials and current technology. Replacement value is not the same as reproduction value, which is the cost of duplicate asset based on the current price. Replacement value and the reproduction cost are used in the valuation of tangible assets and that do not produce income directly, such as furniture, fixture, office equipment, and so on. Next, going concern value. Going concern value is the value of business that is expected to continue to the future. It takes into account various tangible assets of the organization. The tangible elements of going concern value result from successful continuation of a business. Going concern itself means continuation of business. Factors like the trained workforce, brands, formulations, trademarks, recipe in fast food and eating joints, operational systems, The going concern value is relevant in the decision of merger and acquisition. Sometimes an in-place value is said to be relevant to assets because they are working and condition and they help produce income. Fully depreciated asset can fetch some value to the business because its place for functioning satisfactorily and generated cash. Equity interest value. Equity interest of an investor in a business can be considered as an investment. The purchase of an equity interest in a closely held company can be considered as long-term investment. Equity is a long-term, and in a listed, it can be viewed as a short-term. Equity interest in listed, it is short-term, and in closely held, that is long-term. The equity investors not only expect to receive the investment back from the company, but also expect to receive a fair return on the investment. So investment and fair return in the form of dividend. In addition, in the listed companies, the investor have an exit route through the stock market. Therefore, capital appreciation is regarded as an important part of a return. This can be expressed in terms of equation. So capital return, capital appreciation, cash flow, that is dividend, plus closing minus opening upon opening, closing minus opening upon opening. First dividend plus closing minus opening upon opening. Insurable value is a value of destructible portion of an asset that requires to be insured to indemnify the owner. Insurance means how insurance works, that only we have to write, but it is in the respect of asset and company and owner. In the event of loss, this type of value has significant relevance sometimes in M&A decision, as insurance reduces the risk of property. Of course, post-acquisition review of insurance coverage of a property can be done with little impact on the valuation. Value in use and value in exchange. Value in use or value in exchange is a condition under which certain assumptions are made in valuing the assets. Certain assumption is a keyword for this. It is associated with assets that are already in a productive use and can be described as a value of an asset. Productive use. Goodwill value. Goodwill is defined as an asset representing the future economic benefits arising from a business interest, or a group of assets which has not been separately recognized in other assets. Goodwill is a specific type of intangible asset that arises when a business as a whole has value greater than the value of its identified intangible asset. Salvage value is the amount that can be realized upon sale or disposal of an asset after it found no longer useful. Liquidation value is the amount that would be realized when an asset or group of assets are sold. Asset or group of assets are sold in a piecemeal basis, means asset to asset. Liquidation value should be taken into account on the cost of getting the assets in a saleable condition as well as those of the disposal activity. Liquidation value, according to IBBI, means estimated realizable value of assets of a corporate debtor if the corporate debtor were to be liquidated on the insolvency commencement date. Next relationship, it is shown as per the value. Like scrap value is least valued because nothing left on that is a waste. So at last it is there. Goodwill is the highest value. Compared to assets of the company, the value of the company is more, that is goodwill. So on the basis of their value, from lower to upper. Process of valuation. Valuation is a process used to determine the economic value of a company, asset, investment opportunity. The process typically involves several steps, methodologies and consideration. Here are a general outline. The evaluation process: first, gather the information, select valuation method, that is comparable company analysis or comparable first company to company, and company transaction analysis, and discounted cash flow means present value of the future, and asset based valuation. Conduct financial analysis by using any of the one method. Do the valuation. After that, conduct the financial analysis, analyze the financial statements. Perform the market analysis. First, financial analysis of the company, and then go to the market analysis and apply the valuation methodology. Utilize the selected valuation method to calculate the value of a company or asset. Consider the risk factor. While calculating, should consider the risk also. And sensitivity analysis. that is evaluate how changes in key assumptions or variable affect the valuation result. Means valuation varies from person to person, that is sensitivity analysis. Finalize the valuation report, comprehensive valuation report summarizing the analysis. Review and validation, and present the findings to the relevant parties and update the valuation periodically. Steps involved in the valuation process are purpose of the valuation, what is the purpose and basis of the value, premises of the value, business valuation approach, determination of required value, documentation, preparation of valuation report. And 3 principal business valuation approaches are market income asset, market income asset, market income asset, market income asset. First market approach is a valuation approach that uses prices and other relevant information generated by the market transaction involving identical or comparable or group of assets and liabilities such as business. In market approach, the valuer has to get reliable information about the comparable or identical asset in a traded in the active market, and such transaction must be recent and orderly transaction as well as identical or comparable. Valuers should not use market approach if the asset has fewer identical or comparable. Means for tea and coffee we can use this. The asset to be valued or its market comparable or not traded in the active market. Sufficient information on the comparable transaction is not available. There is no recent transaction either in the asset or in the market. There are material differences between the asset to be valued and the market comparable, which they require significant adjustment. 3 valuation methods under the market approach. So normal valuation approaches are 3: market, income, asset. And income, further 3 approaches are there: market price method, comparable companies multiple method, comparable transaction multiple method. So first market price, depending on the market price, compare on what? Companies and transaction. Income approach. The business valuation approach is based on the idea of valuing the present value of future economic monetary benefits. This approach estimates business value by considering the present value of future income accruing over a period of time. Present value of future income is calculated using the value of money concept, that is future value is equals to present value 1 into I upon n, 1 plus I whole power n. The most common methodologies are the capitalization of earnings method, the discounted earning method, dividend discount. So in first 2, discount is common, and the first one, capitalization of earning, that is EPS I feel. Cost approach. The cost approach provides an indication of value using the economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility, whether by the purchaser or by the construction, unless due time, inconvenience, risk, other factors are involved. This approach tends to determine the business value on the basis of value of assets of the business. The cost approach should be applied and afforded significant weight under following circumstances. Participants should be able to recreate an asset with sustainability, the same utility. Example, tea only. Tea requires less effort, so no one can charge more than the competitor. The asset is not directly income generating, and the not in a unique nature of the asset makes using income approach or market approach unfeasible. The methodologies adopted under cost: replacement cost, reproduce cost, summation method. Principles of valuation. Principle of value maximization, market efficiency, risk and return, time value, substitution, arm length, consistency, transparency. There is a question here in 397, fourth point. What are excess earnings? Excess earnings are the earnings of the company in excess of the average earnings of the companies with similar activities and size. Everything size and similar is all the same as last year, but this year the profits are more, earnings are more, that is the excess. But it is difficult to define an appropriate capitalization rate. Today, valuation has become an important topic of interest. Various methods and factors are used in valuing closely held business. These methods are not alternatives to one another, but all or many methods may need to be considered to form the opinion. Hindrances or bottlenecks in the valuation. Some of the common hindrances. First, value. Value as a concept is ambiguous. Means if two registered values are there, the last valuation will differ because he considers something, he considers something. It is a ambiguous. Everyone has opinion of value about the business, a tangible asset. Everyone opinion will be differ. Mathematical certainty or certainty of one output based on specific set of inputs. So mathematical and valuation may be considered a science, but to a large extent valuation variables require inherent subjectivity. So which method I have to consider, that is subjectivity. And valuation is not a precise science as there is always imperfection in the market. Any business valuation activity is based on the hypothetical consideration that there is an arm length sale of the business. One of the frequent sources of legal confusion between cost and value is tendency of the court in common with the other persons to think of value. In business valuation, the value of interest in business is typically considered to be equal to the future benefits that are to be received. However, this simple definition of value arises from following issues: how to define benefits, future projection, what is an appropriate discount rate. Next, principles to be followed: ethics, competency, compliance, basis, that is type of standard of value, date of valuation, effective date and date of valuation, assumption and conditions, intended use, for means for only which type of people it is used, intended user, scope of work, identification of subject of valuation, data, valuation methodology, communication of valuation. And we are done with chapter 12. All the best.